Hello, everyone. I'm Mark Denchy, one of your MBA student colleagues, and I'm going to be speaking on corporations, specifically what's called fraud on the market and the rights of the shareholder. Some of the principles that I'm going to cover, I'm going to talk about the types of corporations, the corporate veil, and the shareholders' rights regarding securities fraud. So let's start with what is a corporation? It's a self-standing entity. It's registered with the US government for tax purposes. It's created within a state jurisdiction. Now, Delaware is one of the most popular states to create a corporation. 75% of the new companies that have IPO'd are incorporated in Delaware, along with 65% of the Fortune 500. So why is this? It has a very favorable tax structure. It has a separate court of chancery that rules on corporate law. And what this has provided is it provides substantial case law with all of the corporations registering there. But the docket is also limited to just corporate cases. So your corporate lawsuits or litigation is not held up behind the general civil litigation of the populace. So it's very efficient, very expedient if you have to go to trial. Now, there's many types of corporations. I just want to cite them. There's public corporations, which we all know, the large corporations, stock-based, publicly traded. There's private corporations, and these are commonly called closed corporations. These are family-owned, and they're stock-based as well, or they could be held within a group. There's nonprofit. These are educational, charitable, or religious organizations. There is professional organizations, like a limited liability partnership, or actually LLC is a more appropriately a corporation. These are made up of physicians, lawyers, accountants. Now, private corporations. This is interesting because we have several corporations that I came across that are privately held that I would never have bet they were privately held because of their size. You have Cargill, 126,000 employees with an annual revenue of $109 billion, privately held. The Mars Company, maker of M&Ms, one of my favorites, $30 billion annual revenue, privately held. PricewaterhouseCoopers, public supermarkets. Love's Travel Stops, actually a customer of my company's, $24 billion a year in revenue. And then Ernst & Young, 152,000 employees, again, over $20 billion in revenue. And these are private corporations. So why incorporate? Why would I want to do this? One reason is the protection of the corporate veil as I conduct business, or as we conduct business. The corporate veil provides limited liability to shareholders. This could be for creditors or for liability in litigation. It can be pierced by the government. It's not absolute. You can't do nasty things and hide behind this, as we're going to talk about for the next several minutes. The corporate privilege, if it's abused for personal benefit, the government can intervene. If the corporation and the controlling shareholder are no longer separate entities, if I create a corporation, I use the monies in the corporation for my own personal benefit, personal use, and then I decide to transfer the assets of the corporation to another corporation and file bankruptcy in the first corporation, the government can come after me. I am accountable for that. It's not something you can hide from. Now, personal liability can be exposed also when it's used for unethical activity, like the examples I cited there, or other types of deception that we're going to speak about. You may recognize this gentleman. He found out very quickly about how the corporate veil can be pierced. So how are corporations regulated? Since there's a corporate veil, since there is government involvement, externally, the government, the US government itself, the Internal Revenue Service, the Securities and Exchange Commission, and the US legal system all have regulatory purview over corporations. Internally, inside the corporation, there are voting rights. You have a board of directors. They make decisions on direction and operational aspects. They make executive hiring decisions. They make decisions on stock dividends. The shareholders can amend the articles of incorporation. They can approve a merger or dissolution of the corporation or approval of sale of corporate assets. So there are many parties involved that can keep the corporation in line. It's almost checks and balances, if you will. Now let's talk about impact to shareholders. This is where we're going to focus from the corporation down to the shareholders themselves. How can shareholders be impacted? Unethical business practices by the corporation can devalue stock. That directly impacts the shareholders. Lack of fiduciary responsibility by the corporate officers. Could be reckless business ventures. Could be fraudulent accounting practices. We've seen all of these. Some contemporary offenders. There's two companies I'd like to talk about that have gone down these roads. First one is Enron. And I thought this image was very poignant because their tagline was endless possibilities. And once you delve into the financial shenanigans of Enron, you see how it was endless possibilities. They definitely get an A for creativity. It's actually unbelievable. And I do have a resource to cite a little farther down that I think you'll find interesting if you take the time to view it. I loved this graphic. I thought it was very appropriate where Enron really has ended up. But also Halliburton, another company that just simply does not understand the word ethical. Now let's talk about Enron very quickly. The industries they were in, they were very big in energy, obviously. Broadband, I remember them moving into broadband in 2001. And they also started selling weather, if you can believe that. What they were actually selling was weather prediction models. They committed, obviously, massive fraud. They leveraged credit beyond absolute reason. They shifted underperforming investments into non-reporting entities. Now, I thought we talked about corporations being governed, being regulated. How can you have a non-reporting entity? They found an interesting solution. They created hundreds of offshore shell companies. Unfortunately, their employees' retirement was tied to stock performance of their company. So when everything fell apart at Enron, everyone's retirement also fell apart. It's an absolute textbook crime what they did. It's just beyond reproach. Overall, so far, $7.3 billion have been recovered by shareholders. And if you want to watch a very, very enlightening story, there's a video on the internet, The Smartest Guys in the Room. It was a documentary done in 2005. It's pretty fascinating about Enron's rise and fall. It gives you an insight into the players. Now, Halliburton is going to figure into our conversation. They're a little different. They're in oil and gas, but they also got into military support in the early 90s. They started out in 1924 from a consortium of oil companies. They acquired a company called Dresser Industries in 1988. This is going to be significant. In 1991, they started getting into military contracting, which is where they made a lot of money, and they did construction through a subsidiary called Kellogg, Brown and Root, and that was adopted basically from the Dresser's Industry acquisition. They've been accused, just one of the things they've been accused of, what we're going to focus on is accused of influencing stock price by the deception of an asbestos liability lawsuit that they had. And we're going to talk about this. Ultimately, this costs the company $5 billion, and it's not over yet. So what is the cost of all these securities frauds as a whole? From 1997 to 2012, there were over 3,000 securities litigation cases. Companies and insurers paid out $73 billion in compensation. It's a pretty staggering number. Lawyers have collected over $17 billion. And I say this with respect, and I don't mean it as a slam against lawyers. What I'm trying to illustrate here is the enormous amount of litigation and length of the litigation and the costs ultimately to consumers, really, of these fraudulent cases. The costs are just staggering. So the article for my discussion, now that we've talked about corporations and fraud and shareholders, I needed to set the stage for that, is a push to end securities fraud lawsuits that gains momentum. And this just happened late last year. It's by Stephen Davidoff in the New York Times. And basically it talks about fraud on the market. And what fraud on the market in layman's terms, is misrepresentation by a party regarding a security that is traded in the open market and how it affects the price of the security. This misrepresentation may cause a financial loss to any party that relies on the information to be accurate. What it's saying is, if we get information from a company, we are going to use that to decide, are we going to invest in that company, or are we going to divest from that company? Now, where this becomes a challenge is if something really bad happens inside the company that threatens their viability or their profitability, and they don't tell us, but they're a public company. It's really what this is all about. So, fraud on the market, a shareholder must show reliance on the corporate information. Did they really use that information? Did they depend on it? But shareholders are not required to read the actual documents. If any of you do investing, you receive prospectuses. How many really read them? I don't. Nobody really digs through them nose for nose. All the available information about a company is incorporated into its stock price. In theory, if the company is open and honest, the stock price will reflect the market's perspective on that. So there's the idea of the efficient market hypothesis, that inaccurate information would be reflected in the share price, and shareholder does not need to prove reliance because the share price was based on inaccurate information. So let's take this a step further now, and let's talk about three significant cases or legal filings. For fraud on the market, there's the Basic Incorporated versus Levinson in 1986. This was a landmark case regarding fraud on the market. There's a Private Securities Litigation Reform Act of 1995, and then we have the appearance of Halliburton again in Halliburton versus the Erica P. John Fund. So that's why Halliburton ties into all of this. So in Basic Incorporated versus Levinson, it was decided in 1986 by Justice Harry Blackmun at the Supreme Court, dealt with the topic of fraud on the market, and the market price, it was decided, incorporates company information, removing reliance from the shareholder. Now, Justice Blackmun very, very cleverly offered a rebuttal option to the defendants that's basically said if they could prove there is no link between the misstatements and market prices paid, then there is no foul. To this date, that has not been the case. This case made modern-day securities fraud litigation possible, which takes us back to Bernie Madoff and all of the other pyramid and Ponzi schemes. So the Private Securities Litigation Reform Act of 1995, now we're moving forward a few years, it was enacted to limit filing of frivolous or unwarranted securities lawsuits. The courts were starting to get bogged down that if somebody lost money, all of a sudden they filed a lawsuit. It required an increased body of evidence before the plaintiffs could file. I think that's reasonable. It modified how securities class action lawsuits are handled by giving more authority to the judges, and this is pretty important in determining plaintiffs and therefore the classes affected, and requiring more proof of financial loss by the plaintiffs. So let's move forward now to 2013. Halliburton versus Erica P. John Fund. The case was actually originally the Erica P. John Fund versus Halliburton in 2002. The suit dealt with Halliburton's hiding the liability inherited from the Dresser Industries acquisition of their Harbison Walker's division. The products in that division contained asbestos, and there were tremendous amount of legal filings and complaints filed. Overall, it ended up resulting in a $5 billion settlement with 400,000 plaintiffs. Halliburton did their best to kind of hide this liability. When it all came out that Halliburton had this liability because of the acquisition, their stock dropped 42% in one day. Halliburton has filed an appeal back as recently as 2013, and it's an ongoing battle. And the appeal is actually questioning whether Basic versus Levinson should be overruled or substantially modified. It contests how classes are certified, what constitutes a class action, who belongs in that class. And the Erica P. John Fund contends that shareholders' reliance on the statements by Halliburton is presumed, citing Basic and Levinson, that the shareholders had the right to know, and that anything that Halliburton said or didn't say is they are held to that. So all shareholders that were harmed by Halliburton's statements, Even if a shareholder did not read the statements, they can be assumed that they were affected and suffered losses. So what does this all really mean? What it means is that corporations can leverage the corporate veil unethically, as Halliburton tried to do. They can conceal damaging lawsuit settlements, like Halliburton did. But these could also be hostile work environment lawsuits. These could be smaller lawsuits, wrongful termination lawsuits, unfavorable business deals. And this is where we get into Enron with debt misappropriation, inappropriate corporate acquisitions and sales, which Enron rewrote the book on, money laundering with offshore asset hiding, again, as we talk about Enron. So the overall analysis here is that the paper presented both sides of the issue very nicely. It started with Basic versus Levinson through the modern day appeal. It discussed protection of the shareholder. It cited Halliburton's attempt to minimize fraud on the market. So where things are heading in actually all of this, with the Private Securities Litigation Reform Act of '95, it's clear that the burden is being placed on plaintiffs to dissuade frivolous lawsuits. Halliburton is attempting to have Levinson reversed, the Basic versus Levinson reversed or modified to not be held liable for statements they do not make or if they hide negative information. And what's interesting is there's a group of former securities commissioners that are siding with Halliburton that Basic should be overturned, the Basic versus Levinson case. So that, to me, that's a little scary. I think it exposes a tremendous amount of risk, unanticipated risk to an investor. I could invest in a company and thinking everything's on the up and up and find out very quickly my investment is substantially devalued because they just have not been forthcoming. So the current Halliburton lawsuit may actually modify the ruling and start moving towards reducing liability for corporations. It's a scary, scary thought. These are the references I have. Again, Stephen Davidoff, the New York Times, you can find that by Googling it very easily, and obviously our book. Plus there was a slew of other content. I hope you enjoyed this, the last 18 minutes or so, and I wish you the best. Thank you very much.